You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for a little bit of options edumacation. Yes, it is time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which many of you have been mainlining, not just Bootcamp, but all of our other fine shows. If you're just listening to Bootcamp, then by all means, subscribe to the rest of the network. You're missing out on pretty much a dozen or so other shows out there. We'll hit you pretty much every day, a lot of times twice a day, with great content for people of all spectrums of options ability. If you're just beginning, like you're tuning into this show, we got you covered with this. Options Playbook Radio is another great one for you there. If you're a little bit more advanced, you want to get more advanced, Option Block is a good one. If you're getting down the spectrum a little bit more, a little bit of volatility views, maybe TWIFO if you're on the futures options, all sorts of fun stuff there for you guys to sink your teeth into on the network. So if you just listen to Bootcamp, you're missing out. But we love you because so many of you are tuning in to Bootcamp. You clearly do love the program. Keep those reviews coming on your platform of choice to help new people continue to discover this program, which has been going now for, 100 episodes. Welcome to the 100th episode. Spectacular of Options Bootcamp. Hard to believe it's been running for that long, but hey, it's funny. Sometimes it seems like it's been running for much longer. In other ways, it seems like it's only been on for a few years. But Options Bootcamp, the little engine that could and continues to keep on rolling. And we thought, what better way to celebrate this 100th episode milestone than by doing a special double-sized super edition of the show, going back to the old length for you old school listeners out there. And who better to celebrate this milestone with me than the man who's been there pretty much from the beginning. I mean, he's missed a few episodes here or there, but that's pretty much been here for most of them. He is the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring and author of a few options books you probably have read. Mr. P, welcome back to Options Bootcamp on this momentous occasion, sir.
It is so good to be back, Mark. I can't even tell you.
Are you ready to open the floodgates and unleash the masses upon us, sir, for this supersized double episode spectacular?
Indeed. This is going to be fun. Just like the old days, man.
Just like the old days, indeed. Let's see how many of you can come at us. We're opening up the floodgates. It is time for your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, I say that in jest, Dan, but maybe we'll regret those words. Our listeners are coming at us hard with some epic treatises on all things options. Good thing we have a full hour to break some of these down. So are you ready, Mr. P? Have you put on your question answering pants, sir? Or any pants at all?
It's pandemic. Pants are not required, I thought.
That's true. For our network, pants are optional on the network. I forgot that. That is in your fine print of your contract there. So I apologize, sir. All right, let's kick it off. Let's start easy. Start small and build. Let's start with a little bit of love, too, because There is so much hate and anger and anxiety out there in the world today. Let's start with a little bit of love. This one coming from just a Google user. So I guess they wanted to stay anonymous over there. But it was a 5-star review over there on the Googles from, quote, a Google user. Well, thank you, a Google user. He or she says, great app. Oh, this is on our app on the Google App Store there. A great app! Exclamation point. Thanks for your continued efforts to educate the retail investor about options trading. Well, you're welcome there. A Google user. Yeah, a lot of you like to leave reviews on our app as well. Those are certainly welcome. It's just another way for you guys to get our content. It's an easy way for you guys to get all of our content in one place. So we don't talk about the app as much here, but it's a great option for you out there, pun intended. It's on all the platforms, iOS, Android, even Kindle Fire for those of you out there. So you can get it there as well. So those of you who are always asking, how do I get this one episode? iTunes doesn't have it or whatever. Some of these platforms limit you to the most recent, 50 or so episodes. And for a show like this that's been running for quite some time, 100 episodes now, that could be challenging to get some of the early ones. So a place like our app or our website, you can always get everything there. So the app is a good place, and thank you for that 5-star review there, a Google user. All right, Dan, I held on to this. We talked about it a few episodes back with your buddy, Mr. Rhodes, when you were on your sabbatical there. So I thought I would leave this one for you. I thought you might have a different opinion on it than me or even Russell. This was from Theodore Domzalski. He sent in some epic treatises in the past. This was a long one, but the nutshell of his question was, how do you forecast market direction? Do you use technical analysis or fundamental analysis? I started by using news. The news looked awful. I put a position on. Next thing I know, it would get worse. My forecast would still be wrong. He also included in this, it still cracks me up. Look at these burgers, which are covered in cheese, which will play an important role in an upcoming question that we have here. But Dan, I know you like to play a little bit more technicals than myself or perhaps Mr. Rhodes does out there. So what are your thoughts here? How do you like to forecast market direction, sir?
I just can't stop looking at these burgers. It looks pretty good.
Those burgers do look good. I told them a little bit too much for cheese for me, though. I'm a little lactose intolerant, so I'll have to go for the non-cheese ones.
Dude, just take a Lactaid.
Don't you love our fans? They send us their barbecue pictures just out of the blue.
And he's doing it right. Charcoal grills are hands down the way to go.
Yeah, this guy's hardcore. He's gonna light up the charcoal. He's gonna let it burn for a while. You got to really invest time and effort in a charcoal grill.
I like it. So how do I forecast market direction? I do a lot of astrology. No, I'm just kidding. But
what are you? You a Scorpio there? What are you, sir?
Aries. But actually, when I was down on the trading floor, there was a guy in my pit who literally said that he used astrology to forecast stocks, and he could bend spoons with his mind, is what he told me.
Interesting.
I've never witnessed it.
Strangely enough, that's not the weirdest thing I heard on the floor of the CBOE. That's just kind of a normal Tuesday.
Yeah, that's not even the top 50. So for me, there's a couple of different things here. And Mark and I have both kind of hammered this home a number of times throughout the last 100 episodes, that there's a difference between traders and investors. And, I'm speaking right now mostly as a trader. And as a trader, I apply about 95% of my forecasting to technical analysis. Now, I do appreciate that there will be people who say technical analysis is blah, blah, blah. It's hooey or what have you. But a couple of things. One is, I think there is something to it if you understand exactly what it is. It's not really predictive, but it's context, which makes it easier to make decisions about the future. It's a map of human behavior in the past. Will the future continue to be like the past? Not necessarily, but it gives me some context. Now, the reason why I don't do a lot with fundamental analysis is because I'm just not good at it. I wish I was. I wish I could sit here and tell you that I am, but I'm not. And I found that when I start looking at markets, either the broad market or a stock, and I start thinking, oh, well, this happened, so that means that's probably good for that company, I'm wrong with some sort of statistical disadvantage that seems impossible. Like I'm wrong so much more than I'm right. when I'm trying to guess what'll happen based on news that comes out. So I stick to what I can see with my own eyes and what makes sense and what I found works, and that's technical analysis.
See, how did I know you'd have a more favorable view of technical than we did on that? That's why I wanted to leave that one for you. To have a little bit of a voice for the technicians out there. I had all my technical love beaten out of me on the floor of the SIBO. And I realize that's a shorter-term time horizon. You're trying to use it to predict usually intraday swings for an underlying, which is what we used to do to try to calculate our gamma scalps. And it never really worked. So that kind of burned me off of my interest in technical analysis. But I'm glad to see it works for you. There's somewhere out there, I know in our audience, who are diehard adherents. I wanted to make sure you were represented, even if I think you're all a bunch of crazy people. I'm just kidding. Don't send your hate mail to Dan. Not to me. All right. Next up. Oh, Dan, we had an interesting poll on the network over the course of the past week. A lot of our listeners chimed in. Let's just give our listeners a bit of an update on the results. We were doing kind of a mid-year kind of update, checking in on what people's thoughts were for end-of-year volatility. Quite simply, where do you guys think VIX and spikes were going to close at the end of the year? We gave you 4 ranges. Obviously, it's a Twitter poll, so we can't go into minute detail. I have to kind of just give you broad ranges. But the 4 ranges were around here, which is where it was at the time, and indeed still is, 18 to 25. Higher, 25 to 35. Lower, shy of 18. Or much higher, a.k.a. north of 35, which was there not too long ago, listeners. So we put that out to our audience, and our audience, Dan, was fading a little bit of the market, going a little bit upside on the vol front, saying higher, 25 to 35, with about 32% of the votes. It wasn't a overwhelming majority of people picking that, but now if you add in the other portion of our audience, which was actually number 2, much higher, at 23.6%. Now you're talking about 55% of the audience, so a clear majority are saying 25 or higher by the end of the year, which is kind of interesting. Then we have a tie for third place with around here 18 to 25 at 22.2%, and lower, so below 18, also at 22.2%. So Mr. Dan, does that surprise you that a clear majority of our audience is saying 25 or higher by the end of the year, or is that kind of what you expected?
This does not surprise me at all one bit. I would probably not just agree with the higher camp, but like when you look at the distribution of these answers, there's only 4 categories here, but I mean, it's kind of a high standard deviation, like we've got 22.2%, lower or around here, and almost the same for much higher. So like that means there's a whole bunch of uncertainty too, and that's exactly how I would characterize my guess of the future, is that probably higher, but I've got a bunch of uncertainty. Like I'm right there with the masses, Mark.
You're there with the masses. Well, if anyone who doesn't have uncertainty for this year, they're not paying attention. Certainly what the vol futures are pricing in is a whole heck of a lot more vol throughout the end of the year and perhaps beyond, even into January, even through Inauguration Day, if you believe some of those conspiracy theories out there. All right, let's keep rolling. BK Rick is next. He wants to know, do companies have any benefit in holding PR until after options expire? I'm assuming by PR you mean public relations, a.k.a. press releases, other things like that. Until after options, I'm not really sure what you're getting at here. If you're talking about listed options, Eric, there's an expiration pretty much every week, unless you're not that actively traded of a name. Then you have an expiration every month. So holding beyond what listed options expiration, I don't really see much of a benefit because there's always another expiration down the road. Now, if you mean what some of these corporate offerings, of course, we were just talking about with Kodak very recently, how they didn't do a lot in the listed space that looked shady ahead of that announcement of their massive loan, but they did a lot, certainly, on the corporate issuance space that seemed pretty darn shady. They issued their CEO and others a lot of very favorable strike price options the day before that deal was announced. Now, do companies have any benefit in holding their press releases and things until after their corporate options expire? I guess it depends. If it's a really bad news, then perhaps, yeah, maybe they want to hold off on that to let their people come in and exercise. But that would also be horribly shady out there. So I'm going to go out on a limb and say, really, there's no meaningful reason unless you have some really dire thing you're about to announce. And you also have a CEO sitting on a bunch of options that are about to expire, and he can cash them in and get some stock. But still, he's holding on to stock at that point, so it's not going to work out well unless he can hedge it, which he can't. So I'm going to go out on a limb and say no. Mr. Dan, any thoughts here for this kind of confusing question from BK Rickser?
Yeah, I mean, a couple of thoughts. I mean, first of all, actually, you brought up a really great point, Mark, that's, the corporate options or warrants or whatever might come into play with that. Like, yeah, I can see that happening because the officers have some control over that, but yeah, like totally. As far as listed options go, I mean, unless there's somebody like crazy insider trading, which you're going to get caught. I mean, you've got a pretty good chance of getting caught. So I don't know. Maybe I choose to be a little naive on that, but I don't think that happens as much as the conspiracy theorists think it does. But like, yeah, I mean, listed options are for the general public. I mean, I see a real disconnect between making corporate governance decisions and the listed options market. I don't see a connection there.
Yeah, if the large companies cared about options expiration, they wouldn't all be announcing right around expiration Friday all the time, Dan, which they all seem to like to do. If they gave a crap about that, they would have stopped doing that ages ago. So I don't think they do this. But of course, the recent Kodak stuff is certainly interesting. That wasn't well timed at all. So that can maybe be a counterpoint to this, that maybe they should have held on to this until after all this madness. Dan, have you seen this madness with Kodak of late, and any other thoughts on this topic, sir?
Oh, yeah. I mean, it's always interesting to watch some of this stuff, but I actually I want to take one little step back too, and just kind of, since the focus of this is education, like it's important for everybody to understand that, like, if a company, whatever the company is, BP, Apple, AT&T, like, they don't have anything to do with the listed options that you would trade in your brokerage account. Like, those are listed by the exchanges, and like they don't ask permission of the companies to list them. Like, it's like there's complete, like, it's a completely separate thing. Like somebody could go and list an option on, any company they want without asking the board of directors, hey, do you think it's okay? Like, it's totally different.
Good point, sir. So hopefully answered your somewhat confusing question, BK Rick. Let's see. If you have more details you want to share with us, maybe you mean something else by PR other than public relations, hit us up. Let us know. Maybe it means portfolio rotation. These acronym soup is everywhere out there. All right, next up, speaking of acronym soup, 565U. That's our next interestingly named listener. He says, do you guys feel that big funds and asset managers tend to overlook things like implied volatility in favor of analyzing the net cost of a trade? They care that an option costs $3, not that it's an 88 implied volatility. They think that it will be worth $10 at expiration. That's all they really care about. Interesting question here, 565U. I don't know why I can't say that name. 565U. This kind of goes back to what we were talking about a little while ago on the show, Dan, with this whole notion that for a certain segment of the audience, as he points out to here, some of the institutional and kind of funds, the Greeks are maybe a bit of a secondary consideration. We always go on about delta, gamma, theta, and vega. Heck, you wrote a book about that whole subject. But he wants to know, here or she, is that really not their main consideration? They're looking at the price, the value. They look at the expiration graph type P&L and say, hey, this could be worth this at expiration if I buy it for less and it's worth more. That's all I really care about. I certainly think there is a subset of the audience that views the option space in that lens. As you said before many times on this show, it's hardly optimal because so much of what's important with the trade is what happens in the interim between when you put it on and when you take it off. Things like theta have a way of intruding. You didn't plan on it, and all of a sudden, hey, like let's say in this scenario, they buy an option that costs $3, and they don't see that it's got a huge gamma, a.k.a. a huge theta, attached to it as well. And now they're doing something else, putting on some other trades. They come back to this trade a week later, and guess what? This option's worth $1.25 now. So they've lost over 50% of their trade. Now, they didn't factor that in, perhaps, in their initial calculation. Now, are they still going to hold on to it? and wait for it to get to this mythical $10 you're talking. That's a much longer climb now than it was just a week before. Or let's say the vol comes in and has a huge Vega component to this. Now that same option, again, could be worth $1 and change now. You've lost over half of your investment when nothing else has really materially changed about that name. Now you have a much longer break even, much higher climb ahead of you. And also you could maybe have triggered your stops. You could be out of it. You could say, hey, if I lose 50%, I'm out. So there's a lot of these considerations that if you just look at the net end result, you're missing out, because how you get there, it's not always a straight trajectory. It's a lot of zigs and zags along the way. And if you don't know what to do when it's zigging and zagging, you're going to miss out. Dan, I have a feeling I know where you fall in this debate as an author of a tome about the Greeks, a very weighty tome. What do you have to say here for 565 you, sir?
Yeah, when you said that there's a subset of our listeners who maybe don't look at implied volatility and, the Greeks, yeah, there definitely is. But those are all like brand new retail entrants into the option space. Like I'm going to make a sweeping statement and I'm going to retract part of it and fine tune. But like the sweeping statement is there is not a single professional option trader, money manager, big fund asset manager who trades options, who doesn't look at implied volatility, because if they do, they will not be a fund manager or an asset manager very long. It's just foolish, like it's like you can't be a professional and trade like an amateur, That being said, the one part I'll carve out of there is there are a couple of asset managers who are like covered call traders only. And the good ones still look at implied volatility and obviously the Greeks. But there's a little bit of forgiveness there. But still, if you want to be good at something, you put all the factors that you can in your favor. And it's amateur not to look at that stuff.
Yeah, even if you're just doing covered calls, if you're ignorant of the implied vol level that you're selling, if you're ignorant of the theta, those are things you're missing out that you could tune to maximize your position. If you're selling an implied vol that is 2 standard deviations below the historical norm for that option and that name, maybe you don't want to sell it. You're not getting a good risk reward. That's some very basic level analysis you probably should be doing on behalf of you or on behalf of your clients if you're managing their covered call money out there. So short answer, 565U. We don't think that's the optimal way to do it. And there obviously is a subset that does. And we had a guest on not too long ago on the network who argued in favor of your position. Go check that one out if you want to learn more out there. But it is an interesting topic. But at the end of the day, we want you all to be informed, well-armed, well-educated options traders. So it's kind of hard to advocate in favor of ignorance of any of these core options topic if you want to be successful in the long run. All right, Dan, I mentioned some of these epic treatises. Here we go. Next up, we've got Austin Beerwinkle. I hope this is his real name because that name brings a smile to my face. I'm going to pretend it is. Austin Beerwinkle wants to know. He's got an epic one here. He's going all the way back to the beginning. He says, all the way back in episode 34, you answered a listener question concerning the uncanny multiple meanings of the Greek delta. Drill Sergeant consensus was unanimous in that the probability of an option will expire in the money definition is more of a trader's rough rule of thumb than an absolute mathematical truism. What do you think of this thought experiment in defense of delta as a true mathematical probability? All right, buckle in here, listeners. This gets a little epic here. If I own a call on XYZ underlying, says pick any strike, and XYZ starts the day trading at 100, then ends the day at 101. That dollar gain only means anything to me if I predict my call will expire in the money, correct? That is, imagine that I fast forward to expiration Friday and look back on all the individual daily moves of XYZ since I bought the call, viewing each as an independent knob, in quotes, that turned or die that rolled, which then got summed together to get me to wherever I am at expiration. If I'm in the money, each dollar the underlying moved is a one-to-one a dollar into or out of my pocket. So for every day knob die that uniformly that got me to my final in-the-money return, I am 100% sensitive to all of them. Uniformly, I can't vary on any of these single returns, even a cent, without affecting my bottom line by the same amount. Yet, if I'm out of the money, each dollar the underlying moved is completely meaningless to my expired call's final $0 valuation. I am sensitive to none of them. Individually, since given I ended out of the money, then I know my call is worthless no matter what each day's move was. This is, after all, just another way of describing a naked calls P&L chart. There is a zero slope out of the money, a plus one slope in the money, no gray area, etc. I'll try to consolidate some of this here. Could you not say that all market players are implicitly doing this 0 or 1 calculation when they are obliged to value in today's change in the underlying at any given strike? They are forced to give their answer, will today's move count in the end or won't it? Sure, they can hedge, play both sides with some weighting between 0 and 1, but mathematically this is exactly equivalent to the expected return on today's plus $1 change being worth either plus 0 or plus $1 at future call expiration, and is therefore, very rigorously, the market's probability that my call will expire in the money. To sum up, all right, here we go. Thank God, he's summing up. To sum up in one statement, delta is indeed a probability because of the unique binary 0 or 1 slope of an option's value at expiry or exercise as derived from out of the money or in the money status, which just so happens to equate the collective market's future expected return on that status with today's sensitivity to a change in the underlying, which he puts in parentheses. The first derivative definition. He says, do you buy that or am I missing something? Oh, yeah, it's a little addendum. Then I'm exhausted, Dan. I can't speak anymore. He says, by the way, love the show. My entire options experience comprises of a recent bar chat with a new friend, quickly followed by these 34 episodes and counting of Options Bootcamp, and 20-some pages and counting of Natenberg. Cheers for the lasting, timeless, and freestanding resource you forge for soon-to-be retail traders like myself. Best regards, Austin Beerwinkle. Well, so Dan, he hasn't even traded options yet. He's very new. He had one bar chat. But he wants to dive into the fray of the probability value of delta and its definition as a Greek. If you want to check out what he's talking about, listeners, go back to episode 34 where we talk into this. But, the synopsis of this, obviously there's a lot of different definitions of delta out there people use. Of course, the most meaningful one for most of you is the amount an option's price will change per $1 or 1 unit move in the underlying. It's the one most of you hang your hats around. But one of the other ones that has gotten glommed onto it over the years is the probability of an option expiring in the money. And it does have a rough truism to it. At the money is things bouncing around, so it's kind of a coin flip, 50-50, whether it's going to stay there or tick in the money or out of the money. Farther out of the money you go, the lower that probability. The farther in the money you go, the higher probability. So there is a rough association with that. But Dan, you wrote a book on the Greeks, including delta. We have to say here for the creatively named Austin Beerwinkle, defending the use of delta as a probability indicator, sir.
Jesus Christ, man, that was a long freaking question.
Yeah, I need a drink and a break after that.
Yeah, no wonder he's hanging out at the bar talking about options. I'm ready too. Yeah, so look, listeners, here's one thing I can tell you for sure. And we might have mentioned this in the past 100 episodes, but traders have short attention spans. If you want a good answer to a question, keep it short. But fortunately, Mark was kind enough to send over some notes so I can actually read through this. Otherwise, I would just ask to move on to the next question. So Mr. Austin Beerwinkle, there is a fatal flaw in your logic here, which is okay because you haven't traded yet. So that's good. Right now is the time to shake out all those fatal flaws. So here's the thing. Almost no one holds options until expiration. That is a very not best practice, I guess, as they would say. It's really, really important to close all your trades prior to expiration. Winners or losers, because at some point the risk reward's just not there anymore and you're tying up risk capital and it's silly. So like that's fatal flaw number one. And related to that, this is sort of a postulate of fatal flaw number one, which we'll just call FF1 going forward, is that like, I don't care if a call I buy ever becomes in the money. That doesn't matter to me at all. Like, I mean, there's of the last 50 long calls or long put, for that matter, trades that I traded on the ones that made money, I'd be surprised if out of 50 of them, 3 of them ended up in the money. Like, that's not relevant to making money, Like, your first point there, if I own XYZ underlying and it starts the trading day at 100 and then ends the day at 101, that dollar gain only means anything to you. No, what that means to you is you just made money. Go buy something. You just made money. So that is the end game. The end game is not waiting for it to go on the money. Nobody cares about that. It's you buy something and it's worth more, and you sell it and there's more money in your account. Just to make it as simple as possible.
Nothing simple about this question. We appreciate your epic treatises here, listeners. I tried to condense this as much as I possibly could, but this is an interesting topic. We talked about it before. I think you're best served of using delta as this kind of rough rule of thumb in terms of a gauge, an approximate gauge for probability. What you're mentioning here, kind of this binomial charting, kind of is analogous to a lot of binomial tree pricing methods out there. I encourage you, if you're new to options, check out some of those outside of your traditional Black-Scholes model. You might understand and like that a little bit more in terms of options pricing, because it's analogous to what you're talking about here, these binary moves daily in an option out here. We also had a great conversation. I'm going to have to see if I could dig it up and maybe link it in the show notes. I encourage you, Austin, to go check out our early episodes of our Volatility Views program. We did that show. My co-host on that was one Don Schlesinger. He's an infamous blackjack Hall of Famer and everything else, and we had a great conversation about this exact topic on that show and the various nuanced times when delta does not equate to a probability. It usually has to do with volatility. Volatility is what is gumming up the works there and making it really an exact prognostication or measure, really, of the probability of an option expiring in the money. I'll have to see if I can find that. If not, I'll encourage you. You should listen to the early episodes of that show anyway, because they're great, and Don's a character. But we can find that one. We had a great debate about this exact topic, and I'll see if I can find it. But yeah, you're best served, particularly if you're brand new, instead of arguing on defense of a particular Greek's efficacy. Take your time, learn about all of these, because if you use delta as a pure probability gauge, you're probably going to be disappointed. Save your time, use it as a rough estimate, and then kind of go from there. Listen to a lot more of the episodes of the show. Get rolling. Let us know how it goes with your trading. Maybe start the paper trading account, and then go from there. We like to see these early starting stories. That's what this show is all about, even if their first questions aren't usually as in-depth as yours. Since that was a long one, Dan, let's do a little palate cleanser. Let's go quick again. Let's go back to the iTunes App Store this time. Another 5-star review. This one comes from RX Edward. So maybe he's a doctor. Maybe he's a pharmacist. The subject of his review was great way to get option info. And his review says this is the best way to get weekly option info. Well, thank you there, RX Edward. Of course, weekly, this show is weekly, of course. But if you're talking about the whole network, which is what the app is, then you have daily stuff in there. So if you want to get our app and get the full fire hose of our content every day of your life outside of weekends, pretty much, that's the best way to do it. But we appreciate your 5-star review. If you like what you're hearing, listeners, go wherever you listen to this. Could be the App Store, like all these people are doing. Could be in the Apple Podcast. Could be Stitcher, Spotify, Google Podcast. Wherever you listen to the show, leave those reviews so other folks can continue to discover and enjoy the program. All right, next up, another doctor. This is Stock PhD. He says, I love us at Options. Well, thank you there, Dr. Stocks. I like that. As I've also read over 24 options books available on Kindle Unlimited, he puts in parentheses, which you can get a 2-month free trial for. And as always, my DMs are open if you guys have any questions or want to spitball plays. So if you guys have questions, you want to share them with, maybe you want to spitball plays with Dr. Stocks, he's here for you, Stock PhD. Dan, are any of your books on Kindle Unlimited? Could Stock PhD have read any of them that way, sir?
Yeah, they're on Kindle, but I make a whole bunch more when you buy the hard copy, so do that.
Oh, well, there you go. Go buy the hard copy. What am I saying out there? Buy the hard copy, listeners. Keep Dan and his caviar and champagne out there in the hinterlands of Chicago. All right, next up. Oh, here we go, Dan. Another epic treatise. And I opened the floodgates. I have only myself to blame. This one comes up. This name looks familiar. I think he's a regular listener here. Baiju Thomas. He says, hi, Mark. Hope you are well. Well, thank you, Baiju. A slightly lengthy question about the open interest in the options market. He says, is there any regulation for it that it needs to stay inside the market cap of the shares traded in the cash market for the same stock? The logic being you can only trade contracts up to the total market value traded in the cash market. And he includes a link to an article out of SEBI, which is the regulator in India. And they specifically they have a specific prohibition against this. They say when outstanding positions in an F&O, so a futures and option stock, cross 95% of this market-weighted P&L, the security goes into a ban period. In the ban period, no fresh long or short positions can be taken. You can only close out of your positions. Let's see. He's talking market-wide position limit. Excuse me. That's what they meant by that. Market-wide position limit. There's a limit of contracts allowed to trade. This is all out of India. 20% of shares traded. My question is: do U.S. exchanges monitor the number of contracts open on single stocks and restrict trading similarly? Because we hear large notional value traded in derivatives that can be way more than the total market cap. I've only heard of circuit breakers, which is different from this. Thanks as always. And he also asked if we could notify him if we could answer his question. Okay. Just for you, Baiju. We'll go the extra mile. This is an interesting one. Yeah, there's a couple of ways to break this down. Obviously, India, a different beast than the U.S. Their futures and options market, clearly much more nascent than America's. But, of course, they're coming up. You looked at those numbers we talked about from FIA, which is the Futures Industry Association. They did a global overview of the derivatives market, and India is coming on strong. Their NSE there is doing some paper these days, but they still got a ways to go before they catch up to the mighty options beast that is the U.S. So a little bit different, a little bit easier, I think, there to identify these names that are doing this. And there are, of course, here, first off, position limits in these big names. So if some name has some huge outstanding amount open, that's going to flag it, whether you're a market-making firm, whether you're a trading fund, whatever. They have position limits on individual names. I think that's the first place you're really going to see it bump up. I'm not sure how those position limits relate to the outstanding OI of a particular name. I'd never really heard that analysis called in. That might be an interesting one to notice, though, and how that OI, if there's a gauge for how that should relate to the underlying float of a name and the underlying shares that are traded out there. That's, we're going to have the OCC folks on again in the near future. I might put this one to them to get the exact specifics because they're the ones who write those rules after all. But in general, we see a lot of these names that do a lot more volume in their derivatives sometimes than you're seeing in the underlying stock. Some of these small biotechs leap to mind. Someone's leaping into the calls for size. They think something's going to happen with an FDA announcement, and the name's a cheap $2 or $3 name, and they do a ton of call paper. So this does happen in the U.S. market. It's not specifically prohibited. But I'll put this one to the folks at OCC for an interesting clarification because there might be some interesting nuances for this. Dan, anything you want to add here for this open interest and any prohibitions that come to mind for you, sir, in terms of how much an option can trade versus how many shares it has?
Yeah. Question first. I know I'm not going to be able to get an answer unless our friend here is listening to us live and can answer on Twitter, but Baiju, like I see this is international, thing going on here. Like, is that named after that disgusting Chinese liquor, Baiju?
I think he's from London. I think he's written in before, so maybe they have that in London. I don't know.
Okay, well, yeah, because, oh, my God, that stuff. If you've ever been to China, they'll ask you if you want white wine. It is not white wine. They just call it white wine, but it is the stuff that tastes like something you would clean your toilet with. Oh, my God, it's the worst thing. It's worse than Malort, for all you Chicago listeners. All that being said, so let's see here. Well, I think I do have a fairly accurate answer for this, and I think the answer is no. There's, as far as comparing how much open volume or open interest can be traded relative to the market cap of the shares, there's not. There's not any limits, which is both crazy and interesting, and in fact, that liquidity disparity, which I'll call it, extends also to like just the bid-ask spread and the volume on the bid-ask spread. I mean, there are many times and many names traded where you can take way more control in the options market than you can in the shares and absorb so much more liquidity. Notwithstanding the fact that the options bid-ask spread tends to be wider, but sometimes you'll see, 300 shares on the bid with not much, below that. And there might be 100 options contracts bid, which is like 10,000 shares worth, So it's a very strange and interesting and disparate liquidity model.
It is a strange one. I think you're mostly going to bump into position limits in these individual names. And again, these are kind of, your mileage may vary. They're going to vary by the underlying and how big, obviously, the position limit in an SPX, a lot of size, institutional players, very meaty product, different than other small names out there. So your mileage may vary just depending on the name. And you have to do a ton of size. These position limits are usually very hard to violate. And if you do bounce up against them repeatedly, their exchange will probably be amenable to adjusting them up for you if you keep hitting them for some reason you want to. So that's probably where you're going to run into these sorts of limitations. And as far as I know, those limits have nothing to do with the outstanding market cap of a name. There's a lot of other things that go into that calculation, but nothing to do with the market cap. So it sounds like India may be alone, at least compared to the U.S. in this one. But I'll check. Maybe there's some nuance of how the market cap plays into how these limits are calculated when I talk to the folks at OCC. But the short answer, I think, Baiju, from both of us is no. All right. Damn, we've done a lot of epic kind of out of left field questions. Let's get a more straightforward one. Again, another palate cleanser. We got this question a lot. Well, let's take this one from Ensco11 here, representative. He wants to know, now that our portfolios are almost even after the market sell-off, I think some of them might be up now. We're at new all-time highs in a lot of indices. He says, what hedging strategies would you recommend? I'm going to go out on a limb, Dan, and say you've gotten this question over there at MTM 7 million times over the last couple of months. What are you counseling people over there, sir?
Yeah, I mean, it's crazy. I mean, if you believe that markets are Strong's form efficient in the price discovery process, then you believe that coronavirus has not affected our economy at all. Right? Like,
it's hard to argue.
That's what
we're whistling past the graveyard, baby.
Yeah. Right. So, so I think this is actually a really good, insightful question. I mean, there's a number of things you can do. When you buy puts outright, as a hedge, they're expensive. They decay. And like, if you look at a put that has a length of time that you would actually want, it can be a pretty good percentage of that underlying. And so, you want to be really, really strategic about that and kind of long term. You don't want to like buy a put and tomorrow the market's up and you're like, oh, why did I do that? I'm just going to sell it. Like, no, you got to be pretty decisive about it. And if you have a lot more confidence that the market may take a nosedive, there's tax consequences, but it might be worth selling the underlying right out. For me, I'm slowly scaling into some puts. I bought about 20% of my portfolio in puts thus far, and looking at opportunities like maybe today to start scaling into more.
Yeah, it's hard to argue. People are a little bit concerned at these valuations. We are pretty much unched or not higher on the year at new all-time highs in many of the major indices. So what coronavirus? Great question. And a lot of you have asked similar questions. We've gotten it pretty much on all of our shows these days. Not surprising. That's a big topic for a lot of you. Not the last time. We've explored many variations of permutations of doing that. Of course, you can just go out and buy the out-of-the-money puts. That's the most expensive, but also the most straightforward way. A lot of other ways to do it. You got collars. We've talked about ratio put spreads. Collar with that other short put kicker against it to help do it. Maybe a ratio put out there on the bottom side of that collar in case you want to buy more at a lower level. Some folks even swapping out of their underlines completely, going purely, mostly into cash and a little bit of upside call in case you want to keep the party going to the upside. A lot of different ways you can do that. It kind of depends what you're holding, what your risk tolerance is. A lot of great things. I encourage you to check out not just this show, but all of our shows on the network. We've touched on that topic many times recently there, Ensco. All right, next up, Mel34 says, weird stuff regarding the Robinhood update to their options offerings. Are brokers allowed to change the requirements for level 1 to 3 options trading? Aren't they standardized? Yeah, I've mentioned this before as well, Mel34. I think this is in regard to what we were talking about on a recent show here about Robinhood and, the tragedy that resulted from them not really messaging what's going on in their options accounts very well. And so they said they're updating their messaging, updating their accounts. They also said they're changing some of their requirements for level 3 options trading, which that one kind of resonated to me as well. Because I was always under the impression that those are fairly standard. Now, brokers have a lot of leeway in what they do, how they treat margin accounts, all these other things like that. But the base levels for a lot of those level 1, 2, and 3 are fairly uniform amongst most of the major brokerages. I'd be curious. I haven't seen any updates to exactly what they're doing to that, or maybe what they had in the past. Was their level 3 very minimal, which would be disturbing as well. So I had a lot of questions about that as well. We have reached out to Robinhood, tried to get them on. They're kind of going in a quiet phase right now, as you might imagine, as a result of all this recent madness. But we have a lot of other brokers we talk with on the network, so I'm going to reach out to them as well. And let's talk about what level of standardization is in place for these levels 1, 2, and 3, and how much wiggle room the brokers really have. Because I was kind of with you, Mel. I kind of thought that was a pretty set in stone thing. And now to hear that the brokers are maybe playing fast and loose with it a little bit is a little bit interesting and or disturbing. Maybe a little bit of both. Dan, you have any thoughts on this? And were you under the same impression that level 1, 2, and 3 was fairly standardized across the board?
I mean, just colloquial. Oh, I always have such a hard time saying that word. Colloquially. Yeah.
So that 5 times fast.
Yeah, but there's not there's not a legal or official standardization. Like a firm theoretically could come out and say, well, we have level A, B, C, and D, and they could make them whatever they want, So they're able to change them, and some are looser than others, and some are tighter than others. So yeah, they can do whatever they want. I mean, as far as Robinhood, yeah, I don't know, man. Like I told you guys on this show before, a couple years ago, I saw they were a new firm, and I saw they had no options education and offered to help, and just got crickets. So hey, man, you're on your own.
Well, they're making money hand over fist these days. The numbers are out. They had more darts and more trades, I think, than I'm not sure about darts. I'm not sure if the revenue is associated with them, but they had more trades than I think some of their other rivals combined. So they're doing all right over there despite these recent controversies. All right, let's next up, Bruce Linden. He says, just I'm wondering, how long does it take to successfully achieve a level that allows you to make a living trading options full time? This has been an interesting discussion topic we've had on the show of late, and this is something Dan has done a number of times with clients, getting up to the level where they feel comfortable and knowledgeable enough to be able to trade on a full-time basis. I did also mention in some of my caveats recently on the show that maybe if you want to take some of the burden off yourself as a trader, maybe going full-time isn't the best thing, because all of a sudden now that's how you pay your rent and your mortgage and your food and everything else. And so you have to have regular draws, and that trading account isn't just going up the way it is when it's sitting in your 401k or your IRA or whatever and just kind of untouched and just going up and going up. No, it's actually something you have to use to feed yourself and your family and everything else. That becomes a much more of a mental hurdle for people to overcome. But Dan, you've done this. You've educated people in the past, and they've become effectively full-time options traders. What are your thoughts on how long it should take for someone to reach that level, sir?
Well, I mean, I think it's the path that you take, I mean, like anything else, you can do things the hard way or the easy way. I mean, some people like to just, read a book and then you've got more answers, which leads to twice as many questions. And then you read another book and you've got more answers that lead to more questions. And, 10 years later, you get it figured out, or you do the same thing watching YouTube videos and you find that there's a bunch of goofs out there making YouTube videos who actually never really traded as a professional, or you can sign up for a class, not to plug my own services or anything. And it doesn't have to be me, but, Mark, you and I don't know how you learned to trade, but I can guess because you're a professional trader. You learned from somebody, somebody showed you what to do and then you could do it, and I mean, how long were you a clerk?
I had an abacus in my parents' basement and I kind of learned that way, Dan, slowly over time, moving those knobs up and down really is a good way to understand and approximate. No, I've made this analogy before here on the show. Dan and I both took similar paths into the business, a path which is really doesn't exist anymore, which is to come in here to Chicago, which is still the mecca for options trading, certainly was back then. And you had a firm effectively take you on board and make you an assistant trader, a clerk, something like that. And you spent your days full-time doing that clerking job, which was also learning about the option space. And usually you were on a badge as a clerk for about a year, year and a half, maybe 2 years on the outside, something like that. And you spend that time. So that's full time, just learning about the option market. You come back from doing all your daily stuff. You do education. You'd have classes and seminars. Maybe you do some mock trading every day. That's day in, day out. It's a profession. You have to devote the time to it. And then, of course, beyond that, a firm is willing to back you. And just because you get on a badge doesn't mean you're really ready to trade. You haven't really seen a lot yet. So you got to talk at least, that's full time for a couple of years. So factor that in. You have a part-time job now or a full-time job doing something else. You can really only be a part-time trader right now to learn. So factor in probably at least a few years before you're comfortable enough to start doing this stuff, let alone really able to take it on and have the capital commitments and everything else like that. So I think that's a good rule of thumb. If you're willing to devote at least a few years to this, you can, like what's the old Malcolm Gladwell, 10,000 hours, right, Dan? So 10,000 hours. That's I'll borrow that from him. 10,000 hours. There we go.
Yeah, but I mean, well, your one point about how like it doesn't exist to do it the way we did it, by going to Chicago and working full time on the trading floor. I mean, like that is what I try to recreate, just doing it online. Like it takes you 10,000 hours when you're figuring out stuff yourself with a little bit of guidance here or there, but you can shorten that learning curve by somebody just, saying, don't do that. Instead, do this. And here's why. And then like, you don't have to spend, 50 hours figuring that out yourself, So in not just trading, but in everything in my life, I'm a very, very big fan of education. And I won't say I was always that way, but it's just, I beat my, just like a lot of traders who come to me, like they say, man, I've beaten my head against the wall for so long. I've lost like $25,000 trying to figure this out. Just show me what to do. And like me with other stuff in my life, totally outside of trading, like I've done that. And now I'm just sick of beating my head against the wall. Like if I don't know how to do something, I just pay somebody to show me what to do.
Yeah, but Dan has a good point. You can't really take that path for yourself anymore. So your next best option, pun intended, is to find someone who has gone through that path and has been trained that rigorous way. And Dan is certainly one of them out there. So if you have inquiries like this, Bruce, maybe reach out to Dan and see what he can do with you to maybe shorten that 10,000 hours down to 99.50. I'm just joking. A lot shorter than that, hopefully. All right, next up, I just like this handle. So he gets on the show for his handle. Degenerate Mo. I think you had a picture of Mo from the Three Stooges on there as well. So that's extra bonus points as well. Degenerate Mo wants to know, is this degenerate or genius? And he sends a link to a trade, a screen grab of it. It says, theoretically, there's no chance for a loss, according to this software. I'm not sure if this looks like it might be Toss here, a screenshot from. And it says there's a $430 max profit if you put the trade on. Theoretically, you get a $330 credit. It's hard to tell exactly what he's got on here, but it looks like this is a old, broken wing, or as our buddy Mr. Overby would say there on OPR, a skip strike put butterfly in Whiting Petroleum, ticker symbol WLL. At the time of this screen grab, it was trading 93 cents. I think it's trading in the 80s now. And I'm looking at this graph. It's a butterfly, listen, with a broken wing on the downside, so it's a little bit farther out. So it looks like he wants to buy one of the 2 puts in September, so 45 days out, sell 2 of the 1.5 puts, so these are in-the-money contracts now, and then buy one, instead of the 1 strike, buy the 1/2 strike out there. And looks at the prices he's got here for like $1.60, 86 cents, and 20 cents. That looks like that comes out to a debit if you do it 1 by 2 by 1. So you're paying an 8-cent debit to do that, and I'm not sure where your math is here, Degenerate Mo, that you can't lose, because you have an 8-cent debit, so you could most certainly lose that. So I'm not sure what you got going on here. Dan, are you a fan of funky broken wing flies on super cheap sub $1 names? I mean, how can you lose, Dan?
Yeah, I mean, honestly, I'm having a little bit of a hard time seeing the picture here, but yeah. So, how much is the stock? The stock is under $1.
It was 93 cents when he sent this in. Yeah.
Yeah. So, I mean, if you're risking 8 cents, like 8 cents is actually a lot, because you're not going to put it on one time. That'd be dumb. Like you would put it on, some proportion commensurate with what you would do with a typical trade. So yeah, you're risking something. I mean, look, man, there's never a trade that has no risk. I mean, there's just not. I mean, could I go into my Thinkorswim account and like change the price on here of what I would fantasize like to pay for something, and change the price on the other option to what I'd fantasize like to sell it for, and make a chart that shows riskless profit, can't lose? Yeah, but I can't actually execute it at those prices. So, yeah, I mean, hey, man, keep looking for those great trades, but you're never going to find the ones where there's no risk and only potential for winning. Yeah,
sorry, degenerate Mo. I might put that one in the degenerate as opposed to the genius category. But try again. Maybe you'll find another one that we find less degenerate. We're coming up against it here, Dan. Let's go for some quick ones. Let's go for a comment here from S Research Group. This is kind of continuing along the Robinhood tip. A lot of our listeners clearly have that on the brain. S Research Group said about Robinhood, because they were talking earlier how they had a good month. They did more trades than most other brokers combined. He chimes in to say, yet we still had to sue to get our capital back from them, which took almost 6 months, which negated all the, quote, free trades. When the market crashes, they're all screwed. They can't even get the basics right, and now that legit brokers are now free, the non-gamblers should be transferring anywhere else. Well, yeah, Robinhood has had some bad ink also, not just with that strategy, but also a lot of outages. I will point out, though, just recently, Toss had a big outage. Toss is kind of the marquee platform for a lot of people out there, and now they're having outages out there as well. Dan, what are your thoughts here on this guy having to sue Robinhood to get his capital back, and also maybe outages no longer just the sole domain of Robinhood, sir, and the quote-unquote free brokers?
Yeah, I mean, yes, it is unfortunate that Robinhood has handled some things pretty badly and maybe didn't take all the precautions that they could have and should have taken on some certain things. But, that being said, it's, this is computer stuff. There's like servers and wires and shit, and sometimes stuff breaks. And like things are like, all the big brokerage firms have backup servers that are in like a different city from their original servers. And, it should work pretty seamlessly, but sometimes stuff doesn't work, which is, unfortunate. And it's a drawback of this all electronic trading, but, that's not going away anytime soon. So, yeah, it's tough. And when a brokerage firm has a whole bunch of outages and that kind of thing, like it's time to look for a new brokerage firm. But any broker is susceptible for every now and then a problem.
Unfortunately, Dan, that music means that's going to do it for this 100th episode spectacular. Glad we can bring you guys this double-size, old-school episode of the old boot camp. Glad to see so many of you have just been enjoying the program, been mainlining it, been listening to old episodes, sending questions in about those. We love it all. We joked about the epic treatises, but keep them coming. We love to hear from you. We'll try to truncate them to fit them all on the show. We had a little extra time today, which was fun. In fact, speaking of extra time, let's go out with another happy note. Let's go out here from another 5-star review. This comes from the App Store as well, from iTunes App Store, from Mertix007. So he's a spy named Mertix. The subject of his review is, I love this app. And he puts in the review, I listen all the time. Well, thank you for that, Mertix, and for all of you out there who are continuing to listen, to download, to send in questions, to review our app and our show on all the various platforms, to keep new people coming. We love all of you out there. You're the reason, literally, that we do this show. We've been doing it for 100 episodes, and we will keep doing it because we know you love it. The show was on hiatus for a little while, but we brought it back because we love you guys so much. We'll keep doing it. Don't you worry. Options Bootcamp, here to stay. And Mr. Dan, sir, if you have any thoughts you want to share with our listeners on this epic 100th episode milestone, have at it, sir. And also, if folks want to ask you more questions along the lines of what we heard today, where should they go? What should they do?
Yeah, I mean, hey, the first thing I want to say is thank you all for listening, man. 100 episodes, I can't believe it. That is pretty humbling that you guys will put up with us for 100 episodes. Thank you very much, and keep it up. Like, you guys are the ones who are really putting in the work to get there and make it happen for yourselves, and that's super awesome. So great job, and thank you. And if you want to get a hold of me, you know how to do that. We're just simply at markettaker.com. 2 T's in a row, and I'd love to hear from you sometime.
There you go, markettaker.com. 2 T's Don't forget the second T over there. You can kick the tires and light the fires over there, of course. Ask him, use questions if you want to debate Delta. That's a probability. That's a good place to go. Check out his books while you're at it. Hardcover editions, of course, so Dan can keep up his delicious Chinese white wine addiction that he has over there. And on behalf of Mr. P and indeed myself, I'll thank all of you out there for downloading, streaming, subscribing, for sending in your questions, for reviewing us on your platform of choice, for all the things you guys have done to keep this show going for 100 episodes. Here's to 100 more. And we'll see you back here for episode 101 of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.